talk about secure ranges tonight. Let's get the chat up for me over here. As always, if you guys have anything to ask or comments, please drop them in the chat. I am going to watch while we go through this together. So this is Jason Allen Jankowski's time compression trading. At this point, most of us know we're coming up to the 5th night that I've gone through this this book here in this part 4, 5 basic market structures. So we've looked at topping markets. We've talked about what happens in them. We've looked at a chart, even though it's a little sideways there. We talked about bottoming markets, very similar to tops, but inverted. We talked about secure uptrends and downtrends. And actually, we left off right in the end of the section before I really got to finish. So I'm going to kind of summarize that up before we move into secure ranges. But I just want to point that one last point out. The secure trends are not time compressed. So keep that in mind as we go further into a secure range, because I could argue that a range in a very, very, very large time frame, if we're looking at a lower time frame range, like more like a pole, is a compression. And when that compression is released into an uptrend or a downtrend in the form of a breakout, you lose that compression as you move in the direction that the market has been building in. So he says, secure trends are wonderful, but your real goal with trading a secure trend is to sit tight until you see topping or bottoming. If the trend is secure, it will go until the top or bottom forms. Why liquidate? So that would have been in 2017. You should have been holding on tight until they made that head and shoulders at the top with all of the selling and all of the hype and all of the stuff going on that was indicating that the big boys were probably getting out and selling to everybody else. That's when you want to get out of a secure trend. And then he says, because secure trends are not time compressed, there's little potential for any serious reversal to negate the trend. And we can go take a look at that in a minute here, that in 2017, there was just no real strong pullbacks. Hey, Colin, welcome. He says, you will get corrections against the trend, but they usually are of a significantly lower quality and often represent places to add. This is a buy the dip. You buy the dip on a secure uptrend. He says downtrends, on the other hand, will suffer hard and fast rallies that usually never retrace more than about 38.2% from the actual top to the most recent low. So when people are talking about when we've made a turn and we're into a downtrend and everybody's talking about we're going to bounce here, we're going to bounce here, and we're going to go back to the top. Well, crypto, probably more than these old asset markets, that may be true. But when we are knowingly in a downtrend, we should not be looking for them to retrace as hard, especially if they've left no square ups behind. At least not as hard of a retracement as they make when they make kind of like the moves where you're in the pole. So when you're inside of a pole, you retrace almost all of the move to the top and the bottom and the top and the bottom. A trend, you're going to retrace parts of moves when you overextend. And he's saying uptrends usually have more frequent retracements, and they are often closer to 50% between bottom lows and the most recent highs. So uptrends, they have the momentum behind them, but it's almost harder for them to go up than it is for them to go down. And I think a lot of that has to do with the emotions. When the market starts to go down, people panic a lot faster than they're willing to jump in and push the price higher in an uptrend, right? We're not losing money in an uptrend. So the pullbacks, they tend to retrace further because think about it. If you're running the market, if you're the big boys, you're trying to shake people out as you go up. And it's just people going back and forth. So think of it this way. This is a nice little summary he gives. Downtrends grind lower all the time with occasional rallies that fail. Uptrends are more violent and have larger up action, usually off large moves. In either case, there's nothing to do but wait once you are in with the trend. The trend is your friend till it bends. You want to assume the trend is secure until you see the clues discussed in topping or bottoming. Trends can go for months and months. Stay with them. Or in the case of the indexes, years. We are possibly making a turn out of a longest bull run in history for the U.S. Stock equities, some would argue in the big picture. So that's kind of sums up our ranges, our uptrends and downtrends. Now let's talk about ranges. And this is kind of the old adage they give you here, buy bottoms and sell tops. Okay, so you can almost look at a big picture. The tops and the bottoms are almost ranges in themselves. And depending on how long a bottom is, how long it goes for, whether it's overextended and capitulates, or whether you're talking about one of those everyone's given up on the market true bottoms, markets tend to enter a sideways range when they are in a bottom and they're not immediately reversing. In that range, you can be buying the bottom and selling the top all the way sideways until that breakout occurs. So he goes on to say here, how simple is that adage? Of course, we want to buy bottoms and sell tops. That goes without saying. As we've discussed throughout this book, we're attempting to study the market from the point of view that order flow in one direction eventually will change to order flow in the other direction. And we want to get positioned as near the turn as possible. We know that the lower, now notice he says as near the turn as possible. He doesn't say in the bottom of the turn, in the top of the turn. He says we know that the loser in the market is the fuel that will make the order flow change. Hey, TI, welcome. Good to have you. We know that the perception of price is what creates the change in order flow for most traders, and we want to understand what that perception is to the point of eventual change. So what happens when the order flow balances? When the order flow balances, you get range. When a range is secure, you get very easy money, in my opinion. Range trades are absolutely the easiest money to make, but they're never the largest. You're not going to get that 2,000% run inside of a range. That's going to happen on an uptrend. He says you don't need, he says when a market is in secure range, they're very obvious price levels. You don't need to use an indicator or oscillator, and you don't need any fundamentals. All you need is price range, your support and your resistance, and that's very clear. He says, however, a secure range is a secure range only as long as market participants continue to choose sides. If the range is at or near a top, reflected by a significant high price, the range represents a potential reversal from a high. You need to look for clues that will help you discern that the range is a pause before a new high is attempted. If those clues are there, you'll likely see a breakout from a range to a new high. This is into the pull, out of the pull. Otherwise, a top is likely in play. So if you don't, he says, you will likely see a breakout to a new high if the clues are there. Otherwise, a top is likely in play. If other clues are there, the range is secure for a period of time. So our goal is to determine if the range is maintaining security, or if it's a pausing point and we're seeing the buy side accumulating to build into a breakout to move forward, or is it a top and we're seeing the sellers come in to build short positions, close in reverse, turn this thing around. So let's talk about the psychology of range a little bit. He says the psychology of range is really a very simple thing. If the range is occurring at an important high price, the bulls are continuing to buy the dips, establishing the bottom of the range. The sellers are shorting at the top of the range, expecting a reversal. As long as both groups believe their point of view is the correct one, you won't get a reversal or a continuation. What happens is a period of time where more and more open positions from both sides are executed, and the population of eventual liquidation orders builds as time compresses. This is what we're talking about when we talk about the compression inside of a pole. Sooner or later, one side will gain dominance, but for the present, the order flow is balancing. Arranged is a balanced market, and that event is always temporary. When one side or the other decides it must exit, the order flow will go into the regular imbalanced state, and you will get either a breakout to a new price level or a retracement to a previous price level. Reading the clues correctly will tell you if the range is a pause on the way to a new price level or a setup for a reversal. There's a few things about range you have to understand and be ready to exploit. It's important to note range is usually established on a lower time frame. This is the case because professional traders need the order flow from small time frame traders to either liquidate or initiate a position. Small time frame traders are interested in trading for money they expect to make right now. That means their initiation orders and liquidation orders will both be executed in a short time frame. So that's why it doesn't go very far up or very far down. So he said, I'm going to skip down a little bit here. to where he says small traders buying the bottom of the range will liquidate at the top of the range, adding to the pool of sell orders that include professional sellers trying to use that price area to establish shorts. So they're going to battle it up there. The same thing happens at the bottom of the range. Small time frame traders liquidate their shorts, adding to the pool of buy orders near the bottom. As long as professional sellers are trying to sell into the top of the price area, along with small time frame traders, the market cannot break out to the upside to a new price level. As long as there's that selling resistance, we can't get the breakout. This is a secure range. The process can continue for weeks as longer time frame professionals continue to use the range to position for what they expect next. And as small time frame traders scalp the range for small gains on a regular basis, until buyers or sellers decide their position isn't going to work and liquidate, the market doesn't have an order flow imbalance. So the key about ranges is they are balanced. An uptrend and a downtrend is a constant imbalance that's working itself out. So now that we think about it like that, it makes sense that when we hit these areas, we move sideways. We're in balance. We're not moving up or down. So he gives this figure on the next page. We're going to look in a second at the 120-minute chart for British pound futures. And let me set something up here for a second because I want to turn this. Take my view clockwise. Give me 1 second. Bear with me, you all. I meant to have this one open, and goody me, I did not grab it at the right time. That's okay. We can take a screenshot here. Y'all can see my fun paint studio. Okay, cool. So you all can watch this screenshot, and I'm going to read along from this section of the book where he's talking about what's going on here. So he says, prior to the sharp drop into the low prices seen on February 28th, 2010, the market had been in a steady decline. So here's February 28, 2010. He says the downtrend was secure prior to that point. Okay, the market reached an exhaustion bottom on that day and has never traded at the actual low prints since then. So here's where the exhaustion bottom is down here. Ever since then, it's never reached back down below to that exhaustion bottom. That was our capitulation. Okay. He goes on to say, notice the volumes were larger in both directions, but often from the middle of the range. So this is interesting. The volumes are bigger in the middle of the range. Okay. This one a little bit. Right in here, there's some volume. Right in here, there's some volume. These are areas of compression. These are almost like poles inside of a poles until you get these miniature breakouts. We could dig into lower time frames, talking about fractal movements, moves inside of moves. But let's go on and see what he's talking about here. He says, now let's look at a portion of this range from the perspective of smaller time frame traders. Okay, so he goes on to talk about the other one. He says crypto is different for that, right? No, Brian. Crypto is not different, but the time frames on crypto are highly different. Crypto moves much, much faster. So a lot of this action, if you start to dig into the lower time frames, you will start to notice it a little bit more. So let's go back over to here. And let's take a look at our Bitcoin chart. Let's see if we can find a little bit of what we're talking about here, because I think that helps to illustrate it a lot better. Now, the difference I would say, Brian, in crypto is that these ranges tend to not be as pretty. They tend to get really sloppy and out of control, and they have a lot of fake breakouts. I will give you that. So crypto, I would argue, because it's not as established, is a lot more difficult to figure out exactly whether or not that pole is going to hold, whether or not you're getting a true breakout. It gets tricky, but we can do this. Okay, so we've got here, this was when we made our swing low to 3,200. Okay, and you know, we can talk about all day whether or not this is a bottom, but let's for a moment pretend that it is a bottom. Nobody heard me say that. Cross your fingers. Brian says this should be the same as a penny stock. Kind of. It's more volatile. So yeah, you see a lot more of the sloppiness like you would see in a penny stock. Because again, crypto and Bitcoin, we're talking about billions. Forex and equities, we're talking about trillions, right? A lot more money, a lot more volume, a lot more people back and forth fighting inside those ranges, more liquidity, more room. It's a lot cleaner of a move on the higher time frames. Now, let me get into even the 1 hour here because it is going to get funky. I have to go, shoot. Let me zoom out one more time because that was they put me way over to the right. I hate when we do that. Okay. For some reason, they want to keep launching me over, so I'm just going to drag you all over. Bear with me. We'll be all right. So here we are in our lovely swing lows or bottom. And what happens here in April? Boom. Whatever pattern you think is going on at the bottom there, that's a breakout. Something different is happening, and we can see it in the volume. After that breakout occurs and we reach a new level here, we see a little bit of a pullback and a bounce. And after this final bounce of buying occurs, what happens to the buying volume? Not a whole lot. This is arguably a very sloppy range on a low time frame. And what do you see? You see a pretend breakout here. It depends on whether you want to move it like that, like that. I mean, these things on crypto are really hard to trade, to scalp, because in crypto, what you will see is a lot of the times people will misidentify things. They'll come in here and they'll say something like, you know, this is a trend line, and so we're just going to buy, and eventually it's going to go up. And at this point, you might have gotten lucky on that. But really, what I would argue is this was where the order flow was more balanced. This was a significant imbalance and an up move. And then what do you start to see happen differently here in the buying side? You start to see more buy volume spiking and poking up. And indeed, we see it start to head on up. Okay, we head up. And again, if we're in a secure uptrend, we should see something like 50% of a retrace of our move, right? Something to that degree, he would say. So if that was our breakout area, and that was the top of our move, stay there. Yeah, we got plenty of a retracement on that to argue that this is still going to go up because we bounced it and we kept going. Now, once we established that we were going to hold it up here, there's another little floor there. Here's another little ceiling. They break up. Is it a breakout? Breakout? No, we're not going to break out. Haha, we got you. Look at all the selling that happens here. People that freaked out. And then they took it back up a little bit, and they broke back down into this more secure area. Notice volume happening in the middle of the range. Volume happening in the middle of the range. These are all those things we were just talking about. If anybody is having trouble seeing what I'm talking about, drop it in the chat. But for me, what I just read and what we're seeing in that area is pretty much spot on. It's just a little sloppy. And then what happens? Breakout and another little bit of a compression here. Trying to decide what we're going to do. We're going to keep going. This stuff happens all over the chart. Lower time frames, bigger time frames. Let's zoom back out. Which time frame sits between low time frame and high time frame? Carol, that depends highly upon your own personal preference for your main time frame. For me, I tend to trade on about the 4-hour time frame, at least for figuring out where I'm going to get in and out. But my high time frame is where I determine my big picture. I'm talking about the 1 day, the 3-day, or the weekly. I'm determining my big picture of where I'm at. Am I in one of these areas where I should be worried about a top or a bottom? So, you know, I could zoom out right here to, let's say, a 1-day chart. And you can still see on the 1-day chart, those areas still look like ranges. They're just a little bit smaller. And what do we notice? We come up here. Most of your patterns are some kind of compression. When we're not making a clear movement up or a clear movement down, we're seeing the market compress in between those big and small selling traders inside a price area. And what's happening is the buyers are more aggressively buying to hold their level. The sellers are more aggressively selling to push their level. And that compresses us into a tighter area until one side wins. The buyers finally decide they got to give up and get out of the way, or the sellers come in with such force that they shake them loose. And then we get a break in the action. This is the fake out of crypto I was talking about. This would suggest to a lot of traders who know about their trends and their ranges that, hey, there was some sideways ranging there. We're going to break to the downside. We should keep going. I would be willing to go back and look at the shorts chart. I should be able to pull this up right now and see if people got liquidated there. Let's see. So right here, actually I can line this up with a vertical line a little better for some of you, because I know some of you are all looking at different screens. It's hard to tell. So let's put some vertical lines around this push-up move and see if we can pinpoint what's going on in the shorts. Haha. It's not the biggest sell-off in history, but let me pull up my candles because this just bothers my eyes here. Not the biggest sell-off in history, but it's something. There's a good deal of traders in here who expected this to take off down. And in fact, when it poked down, now that I can see a little better here, when it poked down, notice before that liquidation came in, shorts came in to sell. There were people that were increasing their shorts at this point because they expected that to continue. And we got the crypto fake out. We liquidated the shorts and went up. And then I'd be willing to bet some longs got in, and we continued on down. Now, those of us that know the Trade Crypto Live method, we might call this, let me get all this mess off of here. Just go back to my little
what you gonna call it?
Pattern here.
Who you gonna call?
We might argue a break, a hookah. Where's the go? Where's the go, Scott?
I wasn't looking at your chart. I was over here looking at the little USD chart.
There hasn't been a go yet. Instead of a go, what I would argue we got was a compression. A compression. Look at my volume. Look at my volume. The buying pushed us up out of it, killed those shorts. We don't want to take them with us. We got to get them out of the market. And now here's where we get all of our longs on the hook. We're going to 1 million.
The halving.
The halving's coming. Everybody get in your longs.
Coinbase lets you do it.
They sure do. But what's the smart money done? Okay, well let's really nab this down real quick before I pass it back to Scott, and then I'm gonna pass it back. And he's got some more stuff to look at. Stretch it out so I can see the trend happening. There's
Smart money's balanced out the chart exactly almost to where I told you, but now we have different conditions in the market that could cause them to keep on going.
No, you're good. You're good. I'm drawing my little lines here. Okay, now we can kind of dissect this apart. While we were in this compression, longs were building. What happened is we started making the move. They were getting out of the way. Why would longs get out of the way if we're going up?
Get out the way, y'all. Get out the way. That's a song there.
Could this be some smart money getting out of the way? And then notice what happens after half of the move has started to go on. What happens again? Here comes all these late longs to the party trying to get in for the ride. And all of those late longs that got in, what just happened to them? They got right back out of the way again. Liquidation. If you don't have an understanding of the big picture, if you can't read the signs to a topping and a bottoming market, if you can't look at this up here and recognize what's going on down here and see the shorts getting into close in reverse and telling you get the hell out of this market, and you don't buy into the hype, you don't buy the Bitcoin Santa Claus rally, we're going to $1 million forever. The rally is over when the shorts are telling you it's over. You listen. If you can't tell that, you're certainly not going to know what's going on in here. And if you don't know what's going on, what are you clicking the button for? Unless you're gambling, then we know what you're doing. You're playing. You're probably going to lose, though.